Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Monday, the 23rd of September, and we've Brent crude oil essentially holding at about $75 a barrel. Will this be the day that it actually breaks and closes above that number? We've seen a big climb last week, up 4%, 2 weeks in a row now, where we've seen the price of oil close higher. Let's welcome Ilya Buchev, managing partner of Pentalon Investments. Ilya, has this market now shifted with the Fed cut behind us? We've now moved from a sort of glass half empty bearish sentiment to a glass half full bullish sentiment as we go into the fourth quarter. Your thoughts on a shifting market?
Good morning, Sean, and thanks for having me here again. For a while, I kind of kept my point of view that Fed is actually priced in with a little impact on the market, but now I'm shifting it a little bit because the impact on the Fed is really twofold. There are two opposite forces pushing the market in two opposite directions. One I would call macro fundamental force, and the other one is more flow force. So the macro force, you basically expect lower rates, meaning lower dollar, meaning lower prices in consumer countries, which is going to stimulate demand. But it takes time for this force to play out. At the same time, the flow force is much faster. So what we have seen over the last maybe months or so, a lot of folks were holding oil as an inflation hedge. And now, because the Fed basically signaling we are done with inflation, these lengths exited the market pretty much in a rapid fire fashion. So what's happening here, the shorts already sold their shorts because they reacted very quickly to the signal of the Fed. But the longs are yet to come. So because the fundamental force takes a little bit longer to play around, and we are still yet to see that impact from the lower dollar that's going to push all commodities up. We already seen in gold. I mean, you saw the news today, the gold is printing again near all-time highs, but it's yet to come in oil. So my view on that, again, there are two forces going the opposite direction, but the short force more or less already played out. The long one is yet to come.
Let's welcome Rachel Ziemba, adjunct fellow, Center for a New American Security, and a senior advisor at Horizon Engage. Rachel, your thoughts on the shift from a sort of glass half empty, glass half full sentiment, and is that and how much of that is driven by the rising geopolitical tensions that we've seen in the Middle East in the last week or so?
A pleasure to be with you, Sean, and to share the stage with Ilya and Yasser. So I think we're in this limbo period where we're moving out of this maybe sort of very oversold sort of environment, and I think market testing, as you say, we've had sort of 2 weeks of moving up after a very big drawdown, and so I think the market's still looking for that next move. I think given this upward move that we've seen in a range of other risk assets, I think it's not just a story of geopolitics and the dynamics in the region, particularly given that the sort of dangerous escalation has come between Israel and Lebanon in particular, and hasn't yet impacted oil flows. And I think the oil market is still in a show me the barrels that are out in the market before there would be really a risk in that way. So I mean, Ilya mentioned the move up in gold, but of course, we've seen sort of big rises in U.S. equities. The dollar impact has been a little more ambiguous. I think that partly has to do with the fact the market is digesting not just this larger cut, but the signaling from the Fed of how much they anticipate cutting in the next year, and also a number of question marks about U.S. fiscal policy and what the next administration is going to do that I think is coming in that way. So I think, yes, some additional concerns about regional escalation, but I think this is more, of a bit of a shift in sentiment, and this question mark of how much the Fed's greater move is about worries about recession risks. Now, in my view, some form of soft landing is still more likely than a hard landing. But we are going into a period where we could see a U.S. government shutdown in a couple of weeks or a partial one. There are rooms over the next sort of 3-6 months for some fiscal shocks, and so I think that those market dynamics from other risk assets will be as important for oil as a macro. And the other factor has been, China came back a bit on the margins for demand because oil prices were lower. So that question mark of how weak is Chinese demand, I think, is also there sitting in the market.
Let's welcome Yasser Al-Maliki, Gulf analyst at Middle East Economic Survey. Yasser, obviously the idea of demand weakness, China in particular, has been with us for a while, and it kind of overwhelmed the market a little bit 2 weeks ago during the infamous APEC annual gathering of the energy market stakeholders in Singapore. But where is the supply side? I think in some ways the demand seems more or less consistently obvious that it's not stellar, but it's still solid enough. The question I think more about is where is supply at, and particularly within the OPEC plus countries, and trying to get an understanding as to this, compensation cuts or that the likes of Iraq and others have committed to. Give us your sense of where particularly Iraq is at, but the overarching sense of OPEC cuts.
Thank you, Sean. Yeah, so let's take it from the latter part, which is, where is OPEC plus overall policy stands at the moment. So just to take from Ilya's and Rachel's points that they have just said, starting with the geopolitical side that Rachel talked about, I think that is going to be transient. The sentiment remains bearish, and the market is looking for signs of an updated pathway from OPEC plus on their easing of voluntary cuts starting in December, or are they going to push it again to next year? So the compensation, to go to Elia's points on the Fed reserve cuts, in June, when OPEC plus members agreed to gradually ease those 2.2 million barrels per day, the expectation of a significant cut by the Fed was put in as, it was hoped that it would put some steam or add steam to prices. That is going to take time, as Ilya said. So now OPEC has to consider what to do next. There are several factors. One of them is the situation in Libya, whether there is going to be a political agreement that, end the current impasse or not. But to go to the point, and one of the important factors that you talked about, which is compensation, I think the biggest problem we have is with Iraq and Kazakhstan. If these countries can stick to their compensation plan, this could see a significant drop coming from these countries, and this could bring back the plan on track that OPEC wanted to do, which is, start easing from December, at least according to the current updated pathway. And overall, the group is going to need strong compliance, and that is going to be crucial, especially within the group of 8, when it is going to meet in early November and decide on whether they are going to continue with this or make a significant U-turn on things. Now, with Iraq, there are confident signals from OPEC itself and from Iraq as well that, they are going to deliver on their pledges. But, to the market, it has long ago, Iraq has long ago lost the benefit of the doubt. I think it is quite hard for Iraq to deliver on its compensation plan. They have a pledge to hold exports at 3.3 million barrels per day. I was checking Kepler yesterday. I think it is at 3.4 at the moment. So it's going to be hard. Part of their plans also envision cutting or asking the Kurdistan regional government to cut some production, which I think is going to be politically unpalatable there.
Just on that point of the Kurdish production, do we have, I mean, obviously this is a breakdown between Baghdad and Erbil. Kurdistan was producing more than 400,000 barrels a day 2 years ago before this pipeline shut down and these issues. Now apparently they're back to 250. Baghdad has no authority over that. My two questions is, how do they get that 250 to market? And can it be more? And does Baghdad have any control to bring this in?
Yeah, so that is the big problem there. Yeah, there are these pre-existing disagreements, political, technical, legal, between both governments. At the same time, can you implement such curbs in the Kurdistan oil sector? The contracts there do not allow that. The IOCs now have a new power, which is marketing their production locally to local traders and so on. So it is going to be hard for Baghdad and even for Erbil to implement any of these cuts there. But again, there are so many problems and disagreements between Baghdad on one side, Erbil on the other, the IOCs on the other, that there is no way, in the near term, they are going to agree to work together on either the cuts or even,
which obviously
resuming exports.
Which ends up being a challenge for the OPEC plus plan. Ilya, what about Russia's, do you think, outlook for, Russia compliance, the Russian supply, and your thoughts, what that could look like? Trump returns to the White House, the deal is done on Ukraine, what Russia's oil supply to the world looks like over this coming window of time, over the next 6 months, let's say, but immediately in terms of their compliance with their OPEC plus obligations.
I'll be very honest with you. I don't think I have any particular insight, and I don't think anybody does on what's happening there. But I think the supply is as steady as she goes. So I don't expect any big deviation one way or another. I think the election overall, I think the election is actually a much more interesting topic. Whether the impact is via Russian supply or Iranian sanctions or a lot of other things. On the margin, obviously, election is somewhat bearish in case of Trump victory. And again, the impact is not going to be more on via supply, but a lot more via demand, because the major impact from election is going to be via tariffs. I mean, the supply itself, look, realistically, oil depends on supply only when inventories are very low or very high. And now we are in this no man's land where the inventories are fairly normal. You have a ton of spare capacity. So back to your question on Russia again, as long as they show some reasonable cooperation with OPEC, which is happening, and it's clearly the focus of OPEC, I don't think that's gonna swing the pendulum one way or another. But again, in case of election, I think that's actually one of the reasons why I think the sentiment is so bearish, because the technical folks, and we can discuss this later, they are already selling the market quite aggressively, while the discretionary folks are largely on the sidelines. They are very patient, waiting till the elections. So there are a lot of other commodities for them to buy, including gold and copper and cocoa. So the oil is kind of in the background, in the back burner until the election, because in case of Trump election, that's going to be again a potentially somewhat another bearish signal because of demand. But again, it's not going to be, I don't see any possible impact of US election on supply. I think we're just too comfortable on the inventory side, one way or another.
Rachel, just looking at that sort of point, a U.S. Intersection with the markets, U.S. elections, we've seen obviously where we started our conversation, the elevated tensions and practical conflict. These are not tensions. These are actually, I suppose, some level of a war, you would call what's going on between Lebanon and Israel. It's a longer skirmish on the border. It's now, rockets into Beirut and rockets into Haifa. So this is moving in a certain direction. But my question to you is, what influence does the U.S. government have? They made a very particular point last night to say that they were talking specifically to Israel about de-escalating on this crisis. Your thoughts on where U.S. Biden administration influence is to keep this under control?
Yeah, and then the question mark becomes, what's the definition of control without, in that sort of context? Look, the U.S. leverage, the U.S. has some levers, but a lot of them have to do with things like withholding military weapons in the context of the campaign. That's tougher to do. I'm not too optimistic about the leverage, directly. In practice, part of the problem has been, if anything, maybe more leverage and more pressure on those fighting, Israel in that context. So I think there's also a question mark of sort of U.S. efforts to try to take what are several fronts and try to keep them bubbling over, but not boiling over. So I guess all I'm saying, into things that might be damaging to regional order and regional security, but might not be as damaging to global markets. Right. And especially some of the flows we're talking about. This is where I think Ilya's point, and Yasser's to a point as well, about ample supply, and OPEC that, if anything, will really struggle. OPEC Plus will struggle to maintain its sort of its cuts in this way. I think as a result, even as there may be limited ability to bring this latest front under control, there's an element where the impacts may be greater in areas beyond the oil markets, particularly as we've seen oil markets get used to new transportation routes around the, avoiding the Red Sea. And the key, I think, is probably going to be, from a market and broader perspective, what about direct conflict with Iran? And that's something that I think even Israel is wary of doing, at least at this point. But at this point, I think the Biden administration will continue to talk a bit tougher, but it's not clear to me how much leverage they really wield, and how much Israeli officials are running ideas by them.
Yeah, sorry, I welcome your thoughts on that, and particularly from a context of Iraq. We saw in the last few days that Iraq, some militias in Iraq were the source of a drone towards Israel, and we've seen over the last year, since the tragic events in Gaza, that the resistance arc, if you like, also includes militias in Iraq. Are they notable? Do they offer a potential to join into a more elevated crisis here? Or is this just sort of noise on the sidelines? Your thoughts about the Iraq militias' role and ability to influence this in any way?
Yeah, well, I wouldn't say that they are, on the sideline. There is a somewhat of a crossover and a joint operations command of all these proxies that Iran has, and the Iraqi militias have been involved, either through coordination with the Houthis on firing drones and missiles from Syria, where they operate against, Haifa, and against as well, I think, Eilat and other places. So they are involved. Now, the main question really is what happens if, this escalates into something farther that would include all of these Iranian proxies, bring them in to be involved in attacks against Israel if Hezbollah is oppressed. Now, to be honest with you, I don't see this coming anytime soon. I think we have covered the oil market's perspective quite well, that, it is well supplied. We have a lot of spare capacity. Unless we see a significant disruption, nothing is going to really, shift dramatically. But
on that point, I just wanted to look at this point a second, and because just to try better understand whether the U.S. has influence here, whether controlling this from boiling over. Your thoughts on whether it'd be fair to say that the Biden administration has done a reasonable job over the last year from achieving that goal, that it has kept the terrible tragic events in Gaza contained there with skirmishes around the sides, but ultimately they've done a good job to keep Iran from engaging too much, etc. Do you think they deserve any credit for that? Your thoughts, and if you do, then does that continue?
It's more situational, really. I think, listen, this conflict has been there for a year, right? If the Biden administration had, exerted more pressure on all sides involved, we could have seen that end earlier. Now, they tried, but the problem is that the situation on the ground has been quite fluid. We had seen lots of changes in terms of military and attacks and so on. And this has been extended beyond what we have seen before in the past in terms of conflicts in Gaza and, in the region as well. Now, the point is, you have to also look at Iran. Is Iran willing to see this continued? I think that if the Iranians have taken a decision of sitting on the sidelines and waiting to see what happens after the presidential elections. And this in a way ties Hezbollah's hands and ties lots of the proxies' hands. From the Iraqi context, just to take this to your original question on the Iraqi militias, I think the Iraqi militias have had their own problems with Iran because they feel that they are very much tied, and they would like to do more, and that is of course problematic for Iraq and its stability. At the same time, you have to look at what the Iraqi government is doing. The Iraqi government has been trying to bring back a detente or a balance between Iranian influence over these militias and US presence in the country. And while that balance was manageable before the October 7 attacks and before the conflict in Gaza, now that is quite not well managed. So the US, to go to the last part of your question, the US is having to deal with so many different conflicts at the region that it is really hard to bring everything into a single process. So it's like you have a fire.
Well, it seems that they've done the collection of the elements. Whatever they all add up to being, including for notable that the Saudi and Iranian foreign ministers meeting in New York yesterday, that Saudi Arabia and Iran are finding a new coexistence that is also, I think, contributing to an overarching containment of all these little fires, some of them not so little, and will they continue to do so? Let's go to the survey question and see what the view in the room is. Oil markets narrative is shifting towards glass half full, bullish on March towards $80 in Q4. With the geopolitical crisis that we've talked about underpinning inventories, although Ilya has indicated they are okay, they are low in the US relatively. Obviously OPEC Plus continues to keep a lot of production shut in. So there's a kind of glass half full narrative growing versus China weakness, China bear. Do you agree or not agree with that thesis? Ilya, I wanted to pick up on the comments earlier and your thoughts on where post Fed cut, which obviously surprised the market to an extent that it was so big, i.e. 50 basis points rather than 25. What do you think that means for the financial markets end of the oil market, the funds because they had gone into a historic net short for the first time? Will that be something to help shift back to a longer position? Your thoughts on the Fed move and its impact on managed money into the oil markets?
Yeah, I think in two words to summarize my view, I think financial demand for oil is going to recover a lot sooner than the physical demand for oil. And let me explain why. I think people tend to forget that speculation in the oil market, the sentiments tend to change quickly. It tends to mean revert. And now we are in a situation where most of the bearish news are already priced in. So we're already very familiar with the Chinese demand slowdown. We're already familiar with inflation hedgers selling a lot of oil that was previously held against inflation. We're already familiar with option hedging, but it's all slowing down. So all you need to do is just to have a little pause here. And the pause is going to terminate the negative momentum. You don't need to go bullish, but even a slowdown in the momentum is by itself is already a bullish signal, because then CTAs, again, they're generally 50% of the time they're long and 50% of the time they're short. Now they're at the maximum short or close to the maximum short. So really the only way they can go from here, it's pretty much up. So to me, I think there are so many groups of participants are currently at the lowest sentiment. And again, historically, I've been in this industry for a long time. The sentiment changes quickly, and I do think that financial demand is going to recover a lot sooner than physical demand.
Rachel, your thoughts on the wider sort of geopolitical intersection with the market. Obviously, there is this a very hot crisis in the Levant, but we do have in the background still sanctions on Iranian oil. Now again, sanctions. The U.S. is not recognizing the election results in Venezuela. Where do those other pieces go in this window of time between the presidential election and a new administration? Do they remain frozen? Do they change in any way? Your thoughts and outlook for those other elements to the geopolitical stress in the oil markets?
Yeah, interesting you mentioned Venezuela. One of the things I'm watching closely is a piece of legislation in Congress, right? Congress is trying to get in on the act. Some of them seem to be very odd pieces of legislation that just want to ban trading in the debt. That probably isn't going to do much. But this question mark that in these measures, I think would do more for longer term, to sort of keep future energy supply from coming to the market. Now we've just said, we're probably pretty bearish as a panel about the ability to absorb that. I guess this is all to say that there are risks ahead and questions, particularly for the next administration. But I think in the next couple of months, I don't see enforcement changing a lot. The U.S. on the Iranian side continues to focus on oil cargoes that are being managed or sold on behalf of Iranian proxies and partners. That is only sort of entrenching this sort of dark fleet. Where Russia is concerned, where a number of these jurisdictions are concerned, they're really reliant on price-sensitive Asian buyers, especially China. And one thing that I do think is likely to, be a real headache for the next administration is the fact that this dark fleet, this these transactions have become entrenched and become another part of the market. And that, I think, makes it harder to enforce these mechanisms. And so I'm watching closely signs that whether Russia is able to get their vessels back into operation, even if they're sanctioned. That's still not clear that that's happening yet. But I think this question mark that the market will try to digest of, Trump administration, those close to it have talked tough about enforcement if they come back in on Iran. I think that might be harder to do. They've talked about a quick resolution to the conflict between, with Russia and Ukraine. Not a lot of details there. So I do think this sort of element of having these separate markets and pricing and this segmentation of the shipping market that also brings other financial risks. I think that's likely to be with us for some time. The fact that there's a lot of oil on the sidelines in the Gulf, and continued production in the Americas, I think that limits the impact of risks there on the broader global markets. I know we're running. We were run over.
I just wanted to give you. I just wanted to give you, Sarah, a last word on that specific question. I wanted to ask him because I get asked. There's one question I get asked probably more than most is, how much of this so-called 6 million barrels a day of cuts that OPEC Plus has registered with the world is actually cuts, is actually production that can be returned in a relatively short period of time? From my observations and conversations, much of that is much of those countries are producing at capacity. But yes, are your thoughts on that? How much of that 6 is returnable in a relatively short period of time?
Well, I think you mean the spare capacity. Yeah, I would say with some certain countries where they have better operational control over productivity and so on, especially with Aramco and the UAE, and the UAE has been adding a lot of capacity recently. I think it could be somewhat fast, relatively fast. I think with other countries like Iraq, and maybe perhaps to a lesser extent Kuwait, Algeria, and of course, others from the group. I think it will take more time. There are other bottlenecks with these countries, especially with the midstream and export facilities and so on. But I would say some 50% of it can be returned, within the 90-day, usual estimate, or so that could be done, at least half of it, and that is a lot, and we.
Oh yeah.
Yeah, we are very well supplied. So I think
having the right to do so. I mean, in the context that when you get into these sort of everybody has their percentage of increase, but yet the capacity to increase is in 2-3 countries. I think the market is going to start swallowing that a bit and probably needs to drift away from this narrative that there's 6 million barrels of idle capacity that's on the press of a button, and actually the market may be a little tighter than is noted. We have to leave it there, unfortunately. Oil markets trading, as we said at the beginning, on the doorstep of $75 a barrel. Will they close above? Will this be a week where we move through 75 as we did move through 70 to 75 rather quickly last 2 weeks? Will that momentum continue? We will watch closely. But thank you so much. Wonderful to have the insights today, as always, from our 3 great speakers, Ilya Buchev in the UK, Yasser Maliki also in the UK, and Rachel Ziemba over in the United States. Thank you, guys. Look forward to seeing you all soon again. All the best. Bye-bye.
Thanks, Sean. Pleasure.
Cheers, guys. Bye-bye.
Thank you.